Right, today I'm joined by Mariam, which we had a podcast a couple of years ago, so it's time to catch up. But firstly, I'll let her introduce herself.
Hi guys, my name is Mariam Radi. I run an investment agency and I basically help investors grow their portfolios in the UK. So we find properties, develop them, and then rent them out for them. It's pretty much what I've been doing for myself, that I've opened the doors for, and now I'm doing it for other people with Carl's help.
Yeah, of course. I think the first time we sat down, you just won your awards for your first major, largest investment at the time. So what's happened the last couple of years?
I was a very small fish in a big pond at the time. And the thing about being in London is you're always going to be a little fish in a big pond, no matter how much you grow because of the city and what it is. Since I won the awards, I think a lot has changed in the UK in general. Property prices have fluctuated in a way that we haven't seen before. I won the awards in 2023. And up until that point, you saw a steady influx in property prices. They would just gradually increase. Rents would gradually increase, and there was comfort in that. But now, for the first time in my property experience, there's a little dip.
Right. What dip in value or dip in rents?
Both, actually.
Okay. And even with the rent reforms, and you think that's going to dip more, come back up?
I think with the Renters' Rights Act coming in, it's going to hurt dinner party landlords the most. What we're seeing on auction is a lot of tenanted properties being sold because when they're sold in the open market, realistically, nobody wants to touch them. Either you vacate the property and then you sell it, but on auction, if it's already tenanted, you're stuck with whatever's in there. People aren't buying.
But can't you serve notice if you're selling?
On auction, if you've already bid to buy a property and it's
No, I don't
tenanted,
mean that. I mean, if you want to get out, you can serve notice because you're selling.
Yeah.
That's the reason
But
for
what
it.
I found with a lot of landlords is they're afraid to serve notice and the tenants leave and then they're liable for the
course.
mortgage. So they will try to keep the tenants there for as long as possible because they'll make up their mortgage. Realistically, let's say all the tenants vacate and you don't complete an exchange for 3 months. If their mortgage is $3,000 a month, they're in for 10 grand from their own pocket, which is what they're thinking about. So they usually market the properties tenanted. They will vacate them, but they're not quick to do that, you know?
And then you could have a problem one.
Yeah, who doesn't want to leave?
Yeah.
And then at that point, the landlord's losing money over the mortgage because they just have one tenant, so they're still paying out of pocket. The seller doesn't want to buy it because they want it in completely vacant, and both parties are unhappy.
Okay. Which is why they go to auction.
Yeah, and then they're
So
still
get
stuck.
back to it. Project movement. Well, from there, you've changed tact or changed style of property because you originally were purely residential.
Yeah.
Yeah. Now.
I'm still doing HMOs. The thing with London is people literally cannot afford to rent flats. Everybody always asks me, why HMOs in London? And I'm like, a one-bedroom flat is £1,700, but your average wage for a 20-something-year-old, I'm in my 20s, is £1,800. People don't have the novelty of choosing flats. They have to rent out rooms. So you're always going to be in demand. People will probably rent out further out from London because they have the transport link so they can get to work. They get to save £100, £150 a month. So the HMO market in London is still profitable. However, what we're finding is Article 4 is engulfing the city gradually. And also the property prices in the areas we operate. So we operate in zone 5, 6, further outside of London.
Yep.
Property prices are increasing, but GDV on HMO is not matching that with an increase because the rents aren't increasing as much.
Well,
so
the rents control the value.
Yeah, so then it limits our margins and build costs are going up. So we've got a smaller window to play with for ourselves and our clients.
I think based on that and from when you started to now, it's very rare to come across the perfect property as a 6-bed HMO, I mean, from a house to a HMO, where you're going to get all your money back out.
Yeah, I think
you've got to believe that you might get the one-off property, but as a rule of thumb, money's going to be left in. You get that back on your return of income. That's the long-term project.
Yeah, but see, people say that to me and they kind of roll their eyes and they're like, oh, I'm going to leave money in. And I'm like, well, wait a minute. It's only a matter of time before you get it back. But then also I've been in a situation, you know this, where I've had the option to max out my LVT, pull all my money out. But when you acquire that debt, you're pretty much stuck with it until you switch on repayments or you sell the property. If you're on interest only, your debt is not decreasing.
Yep.
When you've just refurbished a property, then you're going to rent it out on day one at the most than you will ever rent it out, because it will never look as pretty as it does today. So people will rent it out on day one above market price. They're happy, go lucky, they're making their mortgage payments. And then 2-3 years down the line, their rents either match market price, maybe something happens in the economy like we're seeing today, and then it plateaus. Their property value isn't increasing because we've already maxed it out within 2 months. We took it from a little residential, now it's a 6-bed glorious HMO. We got as much as we can. It's not going to increase that much. Other properties will catch up to us. We're going to plateau. Your LVT is the same. Your rental income is lower. Your debt's the same. You're coming into less capital per month. All because you wanted to pull out all your money on day one.
And the other comparison is, if you can afford it, say you've got 100,000 left in, that 100,000 would have been sitting in the bank.
Yeah.
What will that pay you?
Yeah, it's never going to make the same.
But at least you're getting the rental income on a return for that 100,000.
I always, when I advise people, I'm like, if you're in the game for a long time, or a short time, leave your money in the deal, let the cash flow pay you back, and then control your cash flow via prepaid meters, try to get rental insurances, do other things. You're guaranteed to have your money back. You max out, pull all your money back out. Your mortgage is like 2.5K a month, but your rental is like 3.1. You're 900 on a good day on day one. What is going to happen to you in your portfolio when it dips? I know people, you're going to die. They're your clients, where they maxed out their LVT, their mortgage is so high, and then their rents decrease, and they're literally.
But aren't you finding that people now, and it's becoming more and more popular, turn into social house leasing, so that they get a guaranteed rent and a guaranteed mortgage payment? So that is, it might not be as much, or in some cases it's more, but they don't have to care about having to look after it, and 2, it's a set profit every month.
Yeah. I've got a portfolio. There's a reason why I don't do social housing. There's 2 main points that flag up for me. Number one, I'm
not saying it's right, by the way. I'm just saying it's an option that a lot of people are considering.
A lot of my clients want to do it, and a lot of people that are watching this probably want to do it as well. Okay. Disclaimer, this is going to be a little bit controversial, but I'm going to say it anyways. If you want to get into property and you cannot afford to buy a property, your easiest bet is rent to rent.
Yeah.
And so social housing falls under that. Rent a property, get a contract from the council, pass it on. I've been approached by a lot of social housing companies. You go in a company's house and they are less than a year old. They've just been formed. They don't have any business acumen.
Oh yeah, there's no background to it.
They don't have anything. And so they're going to take on your property. They've got it's not hard to get a contract from the council. They will literally give it. They do not care. We have a housing crisis. They'll give it to you if your property is compliant. If you were to default along the lines, then they'll go after you. But at first instinct, they're actually not that fussy, to be fair. So these people will come to you with a contract from the council. They'll sign up with you, and so eager to get the business that they will miscalculate their margins. And I've seen it happen before. They'll take on a property where the boiler's bust. Boiler repair is like £4,000. Their margins per month is like $300-400. If one boiler goes bust in one of the properties, never mind yours, it wipes out their margins for the next 5-6 months.
And then what do they care? What
they do is they can liquidize their companies. Nothing happens to them. It's fully legal for you to run a company that doesn't work and you have to liquidize it. But you're stuck with a mortgage. You're stuck with 6 tenants that you did not pick, that are social housing tenants, that you now have to deal with. That terrifies me. I do not want to be. Malkit was in that position. I don't want to be in that position. That's one of the reasons why I'm hesitant. The second is, if they're good at their marketing and they get enough properties in their portfolio, the council will probably pay them about $6,000 a month. They pay you about 5. They net $1,000, like just example. They have about 10-12 properties like that. At one point in time, they will get a good £250,000 in their account. We've heard it before, where they see the money in their account and then they disappear. They dip. And then what are you going to do? Nothing. You don't have a leg to stand on. The company's liquidized. That right. For me is just too far. Like I'm never really comfortable doing that. And also the novelty of social housing isn't always in the rent increases. You may get a couple hundred more. It's more so in the guaranteed rents aspect. the fact that I don't have to think about maintenance. They know that. So what they guarantee you is typically market price. The novelty is the fact that you will receive that, you don't have to worry.
Yeah.
So I'm getting market price. Okay, I don't have to worry about maintenance. But then I have like this looming risk of
Also, you know, what they do to the property.
and
Yeah.
that's always, you know, that's just my own.
Yeah.
Drop in the comments all the reasons why you disagree with me.
Yeah.
All the social housing people can come after
Could be
me.
upset, yeah. Okay, so then where and how do you find your tenants?
I say when you're doing HMOs, we're just going to think about HMOs, never niche yourself. If you're in for the long run, do not. I know a lot of people that did student HMOs up north, case point example, Sunderland, their admissions dropped by 30%.
Yep.
If you're only doing students HMOs there, something as small as that, a political unrest in the country that puts off international students,
Yep.
hits your market. A new student HMO, student accommodation, is built close to your campus. Why would students rent at yours? It hurts you.
Yep.
I've heard people build HMOs near Universal Studios for the workers or near airports. As soon as you niche yourself and that niche, for whatever reason, gets impacted, why are you carrying the burden? You're in property because it's supposed to be risk-free. It's
what you're
supposed to be the
saying-
thing that survives.
Are you saying a mix is better than one
At
type?
100%. That's why we're in property, right?
Yeah.
Because it's like supposed to be stable. I do London, close to the Elizabeth line, because I've got students from all over. Brunel University, doing PhDs and university I didn't even know existed, online courses. And people that are coming here to work, people that moved out from their home and they want to, you know, test. Divorced men, got a lot of those, to be honest with you, I'm not gonna lie. They're great, to be honest. But you have, it doesn't matter if a student market's hit. The professional one's okay. Professional one gets hit. You know, women will always be leaving, divorcing their men.
It's the same scenario, isn't it, between, say, a single buy-to-let and a 6-bed HMO. If you lose your tenant on a buy-to-let, you lose all your income. If you lose one tenant out of 6, you've still got enough to meet the mortgage. So anyway, moving on from that, you're now gone a little bit out of the box of HMOs.
Yeah.
You're now doing commercials.
I'm doing commercial.
Why?
I'm doing a bit of everything, to be honest. So with commercials, the loans that a lot of businesses took from COVID are now expiring. They now have to pay them back. Business rates are going up, so it's making it harder for small businesses to operate. It's causing the high street to shut down. But businesses are realizing they don't need a massive amount of space to operate. They can do with a smaller room, lower business rates, and I think that everything's a cycle. Small businesses are taking a hit, they're closing down. There's going to come a time, I don't know if this government will realize it, but some government in a couple of years will realize that our high streets need small businesses to thrive. They're going to come up with an incentive that supports them. When they do, at least you're there with your commercial unit ready to rent. Also, I prefer mixed use properties. I know that you get a commercial mortgage, which is a bit higher. But I just like having the mix of incomes with a commercial property or on a 3 to 5 year lease. It's almost like a guaranteed rents scheme without the riffraff
full repairing and
of social housing.
Yeah.
And then you have the residential element. So I find that stuff more attractive. I'm not looking to sell my portfolio anytime soon. So I'm always trying to create something that will withstand.
But also on the commercial,
survive.
sorry, on when you say the residential above, you're still using that to convert to a HMO.
Yeah.
So it's, you've got HMO income, you've got the rental income, and possibly
Flats.
a flat.
Yeah.
So it's you've got a mixture of everything all in one place.
Yeah. And then I feel like it balances itself out.
Okay.
I'm not anti-HMOs when you're in London or when you're close to London. So I feel like young people don't have a choice. All of the people that I went to university with, they live in rooms. So I think when you try to, so I think what a lot of people do is they listen to what one person does in one area of the country and then assume that it works nationwide. It's like, no, you need to think about your locality, your demand, your wherever you are and what's happening around you. It's not a one.
It's definitely changed because,
it's all.
you know, being a landlord is a bit like the buy-to-let market, how that's evolved, because you know, go back 20 years, you know, you had the odd buy-to-let, people would, now it's a trading business. Yeah. Being a landlord is a business. Yeah. Whereas it wasn't really recognised as that before. It was recognised as a hobby. Yeah. And so now, you know, what you said earlier, the single buy-to-lets, people are putting them in the auction, get rid of them. You've got the tax side, you've now got the rent side, landlord side. It's all being affected. So the easiest way is get rid of them. Yeah. And that means the ones that are left, the good landlords, as I say, they are treating it as a business, a trading monthly controllable business.
Yeah. But I think with the portfolio landlords, there's more obstacles they're facing that people don't realize, in that they bought these properties 20 odd years ago, 2008 to 2009.
Chances are in personal name.
Yeah. The capital gains is immense.
Mm-hmm.
They kept refinancing through little brokers like you every single time that they got a chance.
Stop.
And so their LVT versus their capital gains, sometimes they literally cannot afford to take a low offer.
No.
Their CGT liability is, let's say, 100K. Their equity is like 110. Their solicitor's fees, they're a negative equity. And so they're in this
bubble with their stuff on.
And I mean, this is their own fault, but every time they withdrew the money, let's be honest, they never spent it on the property. So it looks just as bad as it did 20 years ago.
But they never said they would either, so I'll stick up for them. So
it looks just
it's on another property. Yeah, I think the idea that it was from what buy-to-let market was to what it is now, i.e. that you buy your property, you do it up, you go on a 5-year fixed rate. After the 5 years, you remortgage, take the money out, do another investment. I think that's going to be a lot harder.
Yeah.
Because there has been a fall, as you say, then that's got to come back up. Some of the fees that are charged by the lenders, the arrangement fees, so it's not 75%. You're either 77, 80, in some cases 82, 83% loan to value the day you complete. Yeah. So, even if your property goes up 10%, you're not getting that equity out.
Feel that, yeah.
So the market has completely changed.
Would you say that that's one of the reasons why people should think twice about maxing out their LVT?
I would say, I'm getting interviewed now.
He's thinking about his own market. He's like,
no,
if they take out less, I get less.
No. I think people should consider either the amortization, including a percentage of it, or taking advantage of the amounts you can pay each year without being charged redemption and paying some of that within the business, because it'll be paying a little bit extra back every month over 5 years gets you back into the parameters of where you want to be. Yeah. So that you could go again if you want to. As long as, look, if you can afford it, then do it. Yeah. If you're living right on the limit, then I would say you're in the wrong business.
How much, just so people know that are viewing this, how much should they contribute a month? Like, as a percentage of their mortgage?
The standard allowance across the board, as a rule, is you can pay 10% in any 12-month period, not
10% of their gross net?
Of the mortgage balance without being charged.
So if your mortgage is 400,000,
you can pay up to 40,000 a year off the balance without being charged.
A year?
Yeah, 12-month period.
Yeah.
So you can't pay on December and then expect to pay another one in January because they're different years.
Carl thinks everybody has 40 grand sitting in the
bank.
Yeah, no,
I don't.
Do it, guys. Just keep your 40 grand.
But there's other ways of doing it. You can increase your payments. You can not, so that you can build it.
So
There's always ways of doing it.
People realize that. I think people go into it. They max out their LVT day one, rent above market price, thinking they're always going to do that. And then they're stuck with this debt, lower rents, and... Yeah. So I don't know. They come back to us and they're like,
you've got to think about it. And if you get that down, you get your book value down, so that you've got more options in 5 years' time. Yeah. So it's just something to consider. Yeah. So anyway, moving on from that.
Oh, sure.
So you've now done your properties. Yeah. Now you're doing projects for people. Yeah. So how did that evolve?
After I did my own projects and I would market them online, people started coming up to me and asking me for help. Started helping them. And then I started charging them, and I was like, "Oh, well, hot diggity damn, I'm in business." So I started the investment agency.
There's people doing it. You've got your background, you've got the awards, you've got the know-how, and you've got the team as well, haven't you? Yeah. So it's not just you doing it; your team are doing it. Yeah. And how long? And you, from what I remember, that team's been with you all the way through.
Yeah. So, yeah, pretty much. We've expanded, but that's where my collaboration.
So again, it's another, going back to what we're talking about. That's another business on the side. Yeah. So, it's not, just you doing it, I'm going to go and design it and do it all myself. Although you do send pictures with the hat on and the.
Do you love him?
Yep. But it's not you
He's
doing all the
lying.
work.
You don't love him.
Yeah. So no, all of that's good. So what next?
I want to keep doing what I'm doing because I genuinely feel like I'm helping people. I think one of the reasons why I started doing projects for other people is although property is regulated, construction actually isn't that much. One person can quote you 10 grand to do a bathroom, the other person can quote you 40 grand, and you won't really know the difference. They'll just say, oh, I'm better or I'm faster or whatever. And I feel a lot of people that aren't experienced in the industry getting just overpaying for certain services. That's something that I experienced myself when I was starting off, so I feel quite strongly about it. When I see it happen in front of me, I want to step in and protect that person. So that's pretty much why I started. I just had a lot of women mostly coming up to me and they want to grow their portfolio, and contractors would just give them ridiculous quotes or upsell in the middle of a project.
Everybody's got a bad story about a builder.
Yeah, literally. So that's I want to say what keeps me in the business. Because it's fun for me and it's easy for me and I love what I do. So it's like, why wouldn't I do it for other people, right?
But I'm very glad to hear that because that means you keep using me. So on that note, I think we'll call it a day of the interview because I'm sure we'll be back again in a couple of years and you'll have moved on to something more as another arm to your bow, or whatever they call it. And you'll be expanding even further. So thank you, Mariam.
Thanks for having me.
That concludes today. Look out on all our normal social media outlets for future podcasts.